Welcome to the Twomey Stock Market Report. I'm James Twomey, and today is Thursday, the June 23rd, 2022. I want to get an alert out to some of our holdings and positions. Verizon, we're going to still hold our last 1/3, and we may be adding to that shortly. DBC, our commodity play. Our last 1/3, we've got the inflection point to signal a sell. So sell that last third of DBC, and we may come back to this and add to it or add again to it. But right now, we got that inflection point, and the next day we got confirmation. Yesterday was up a little bit, and today we want to get out of our last third. The other ones, let's just go over them real quick. Okay, TBT, that's the inverse of the Barclays 20-year Treasury. And it's what I call shorting bonds, all right? TBT is the 2 times, and then TBF is the 1-to-1. So the more risky, play TBT, and then if you're less risk, play TBF. But with that said, our second third got stopped out. So we've got a 4.6% gain on our first third, 3.5% gain on our last third, and we're holding our other third for the inflection point, which is now up 2.9%. The TBF side of it, the same thing. We got stopped out on the second third as well yesterday, and we're going to hold that last third. Let's take a quick look at our daily chart. We'll go at TBT, and that is certainly below our inflection point of the we use the black as the 9 or 10, and then the gold is our either 15 or 14 EMAs, and those are our first and second points of where we want to make our first third and second third sells, and then we hold for this inflection point where we're looking for the 10 to cross below the 15 or the 9 to cross below the 14, whichever one you want to use. We may actually be adding to this versus seeing it cross down, but let's take one step at a time. I'm looking at the relative strength index on the 120-minute chart, and that is down to 40, so it's coming down pretty quick, and the daily is at 52. So we've moved the overbought of 72 4 or 5 days ago. Is certainly we relieved that pressure quite a bit. It's bumping up against our Twomey trend track line. So we will keep an eye on that for you, and there may be an alert to add to our positions. Let's see what's next. Okay, our short of the Nasdaq PSQ. Our second third got stopped out yesterday if you're using our stop. What I did on that, our first initial third got stopped out early on our position for a 7.2% gain. So other segments, I said, take whatever was left and let's break that up into thirds. And so the first third of that second batch, if you will, got stopped out yesterday. So your next third, the stop is at 14.16. We're going to hold our 1/3. So overall, we're up 8.3, and our 2 positions were stopped out for a 7.9 and a 7.2 gain. And let's just take a quick look at the PSQ, which is the inverse or the short position for the Nasdaq. The relative strength index on this one is 56.96. So overbought is in the 60-70 range, right? And then 1, 2, 3, 4, 5, 6, 7 days ago it was 66. So you get near that 70% over what we say bought range. That meant the Nasdaq, the long side, was certainly over sold. So we're getting some relief of that pressure there. We'll see where this shakes out. And as you can tell, we just barely got into yesterday into that 14 or 15 EMA line, and it triggered our last third. But we want to keep cognizant that we want to, major rallies, it's tough to do, and I don't know if we're going to see any going forth short term here, but we want to add a third kind of positions to as these rallies start to develop. I would say my best example, if you had $100 and you want to invest that, you'd probably break that up so that maybe you see a big rally, you add of that maybe $25, and then you see another big rally, you might add 20, and over several days you get your whole 100 in again. But we'll try to keep you alerted on that. Dog is the short of the Dow. That's up 7.1%. We got stopped out our first third, and we got our other stops in there, as we've said before. And they're listed here. And the same thing with the SPY, same story. We got stopped out in our first third, so we got an 8% gain there. And then we've got our next third stop at 16.2 and hold 1/3, and that overall is up 8.9% as of yesterday. Now, the RWM, which is the short of the Russell 2000, we've got that in it just a hair up there on that, less than 1%. But I did change the stops on that. The stop change, take your money, break it up into thirds. The first third, put it at 25.86. The second third at 25.55, and hold the last third. We'll see where this maneuvers. We probably should have got into that a little bit earlier. I was holding off on that because the Russell has been pretty much not giving us the gains that we've seen earlier in the year. But with SJB, risky traders only, because it's not a real high volume trading vehicle. I put the stop at 18.5. We may want to raise that up to 19, but I'm going to take a deeper dive into that over the weekend. But we're holding that steady, and I would consider, this is risky traders only, and I would consider adding at 19.5, 19.55. The problem with the SJB, it is a low volume, and it's the inverse of corporate high yield bonds, which are junk bonds, if you will. And typically in a down market recession, those companies struggle with getting paper out there and get it backed. And then, well, you want to play the inverse of that, of course. But because it's usually a sell-off of junk bonds, it's a rush to the exits of anybody holding them. And this would obviously gain during that procedure. Let's see, even on this high volume day here, there was only 4 million traded. So just be careful. That's all. It has some drastic moves, but as it gets closer to the 9 or 10 EMA, whichever one you're using, which is 19.5. So 19, I've got buys in at 19.55. I bought some yesterday at 19.6. Just to give you my philosophy, I'm kind of adding in on any time it pulls back, but it's holding steady here, and only risk traders only, because this could end badly. All right. What else? Okay, sell buy alert. We talked about DBC, our last 1/3. I'm going to keep an eye on that because I think it's going to come back into play. Add short positions on. Add to your short positions on bounces. If we get some big bounces, definitely want to add to those. The TBT, TBF, just wait. I want that to play out a little bit. Overall, and also SJB we just talked about. I'm going to watch energy for entries. This may be something that we want to take a look at. XLE is the ETF on energy companies and energy services and sector of a variety of different companies. Okay, as we can see, we got a spectacular downdraft there, and it's meeting its last low. It hasn't quite got there yet. I believe it's really exhausting. It's oversold status. We're down to 33. It was overbought, and it was at the 72. It bumped up to the Twomey trend track line and came rushing down, blew right through our Twomey track line on the lower boundary. Didn't even take a breather there, and then we got to the 50, blew through that. I don't know where the 200. It's aiming for the 200 for sure. what we're going to do is just watch this. This may be, my mouse hunt on trade the MACD of the 120-minute chart, get that inflection point. In other words, the fast stochastic down below here, we'd like to see that up to 70, 75. We'd like to see the MACD climbing with the green over the red and then jump in before our big inflection point here. This is on the 120-minute. In other words, we break down the market into 120-minute sections. We look at the rear view mirror, the last 5, 6, 10 days, right? So with that, or even longer, the segments break up into, was it five segments? Well, whatever it is you want. What I'm trying to say is this: I call it a mouse hunt because you think you're out for big game, and using this chart, sometimes you end up with small gains or quick losses. So we'll be watching that for you. But it may be about, we can see we've had a couple of hits of these lows and it's bounced up. And what we like to see is these new lows or the similar lows hit with buying, and then that's gonna play out. The whole thing with the energy sector. What have we talked about with energy? There's real no solution out there. Europe is really struggling. They're trying to, especially Germany, break away from Russia. They have no solution to get their natural gas and oil unless they can get it from other areas. That 45% was coming from Russia. They're now firing up coal plants. That's how desperate they are. The energy sector is still going to see pressure. Here in the U.S., politics aside, there's a war on fossil fuels, right? Everybody is being, well, again, I don't like talking politics because it has nothing to do, but it does include environmental factors. Right now, it seems to be a big push for, abolish fossil fuels and go to electric vehicles and wind, solar, whatever. Unfortunately, that solution is not whole right now. It's a good idea. There's a lot of great technology. It's moving rapidly in a positive direction, but we are not there yet. And we can't go to $10 a gallon gasoline. It'll just kill the economy. But that aside, why is energy dropping? Well, it's a volatile market and there's a lot of speculation. It also is it's based on the future market. So it's saying what oil is going to be trading months out, and that's how the stock market tracks these. And what it's saying is the recession's coming. And with the recession, people are going to, it's demand destruction. And right now the pricing on gas and diesel is causing some demand destruction. People are changing their behaviors. I was talking to a stranger yesterday on the golf course, and I was asking him about, he had just gotten down. I said, how was the traffic? And he said, because we're on the Cape here for the summer, and he said, well, hey, there's no traffic. Nobody's driving. They can't afford the gas. I don't know if it was a euphemism for, hey, I'm tired of these high gas prices, or he was actually correct. But, we'll see. We'll see how that shapes out over the summer, because that's driving season for vacation people, right? Either way, we're seeing a tremendous downdraft. It's very volatile. It's hard to trade this market in energy, and we're going to just keep an eye on it. And if we get there, we'll get you some alerts to buy. But if you do, keep your position small. And if we can get into a nice rally, it's a very, very nice trade, because the rallies can be fast and furious. And if we catch it just right, you can get some nice gains. We look at our sector table, and energy now the last 5 days is I sorted this for 5 days, right? Is at the bottom. And what do we got in energy? Energy equipment and services, oil and gas. Those are our XLE, OIH. It's USO would be more the US oil barrel kind of pricing. UNG is the U.S. natural gas. Up at the top is healthcare. It's of the 5-day forecast, and that's defensive in nature. Healthcare providers, equipment, life sciences, nothing surprising there. So what am I saying here? If you look at the year-to-date close, we've been over this multiple times. Energy, which was up 40-50%, is now only 23. And then the next closest was healthcare at 5, and utilities and materials are usually up there. Materials now -7. Where's utilities? Utilities -11. So anything that was really doing well, materials wasn't that well, and utilities wasn't that well, but they were kind of positive. And now really taking a hit. And that tells you on these rallies, people are selling out of some high flyers that work in a down market, and then are putting money into these stocks that got beaten down the most. And they're looking at those. And then they also look at some of the defensive areas that could come up in a bear market rally. Nothing real newsworthy there, but just to give you a concept. Okay, reason why I say all this, the legends of the bear market rallies. Let's take a look at this. What bear market rallies can be exciting, and they can also be psychologically painful. They get to be flashy, but they're often short-lived. And the market will then grind lower, really putting the squeeze on anything that you jumped in on. So what we're going to see is some of these bear market rallies, especially over the summer, they might seem large, or anything that comes off these bottoms are going to seem impressive. But usually they're followed by deeper sell-offs. Look at the financial crisis, 2007, 2009. The market had many minor rallies from the fall of 2007 through the summer of 2008. This was kind of a long period of time, but there was rallies of 8%, 12%, and then a 7%. And what happened there is, it attracted buyers, and then all of a sudden, boom, we're back into a bear market scenario, and the sell-off continues, and it's very painful. What do I mean by that? Because think of an 8% rally. That sounds big, right? Well, it's very hard to buy at the bottom, and it's extremely high to sell at the top. So you're not, an 8% rally, if you got in at the bottom of 8% and you sold at the top of that, and you're a really savvy trader, terrific, right? I'd like to meet you, right? Because maybe you get a secret I don't have, or others, but the typical investor like us, right? We're gonna see that rally. We're gonna hold off. We're protecting our cash, and it creeps up 3, then 4, then 5. We go, I got to get in. I'm gonna fear missing out, right? And all of a sudden, 2 days later, whoosh, and you see how. If you've been following me, you see those spectacular drops, right? That's why we're keeping our shorts. So, remember, hit the like button if you like what you see, but also hit subscribe so you get the alerts sent to you when they come out, like today's. All right. Overall, if you look at that segment, there was once the market had declined 45 and 51% from their record highs, right? They were met with rallies throughout 18 and 24% in the fall of 2008. And really those moves that came were several months before the market's ultimate bottom at 2009. So it's tough. Rallies are tough. They're very emotional. And if we can play them, great. If we miss out on them and our shorts, we get our third profits, and then we're savvy enough to jump in to gain the last downdraft until the real bottom, then that's good. And typical bottoms occur when the Fed starts saying we're going to stop raising rates. Now, the way the Fed's talking, that could be September. I don't know. We're going to see. I think this recession is going to be different than the one caused by the financial and the dot-com bubbles. Uh, our last segment, we talked about how Mohammed had El Afram. He was the PIMCO bond guy. He just really, really great with bonds and well respected. And he's also saying this is just a mishmash of between SPACs and crypto and now energy coming in and housing. It's just we've got a real basket of things that could blow up. And these bubbles were caused by just excessive liquidity. The Fed was, buying bonds. The Fed was buying stocks. It was over a 14-year period. We had all kinds of crises between the financial crisis and COVID. And the Fed is just, and this is worldwide too. We had negative interest rates overseas. This injection of cash has got to get unwound. And when it does get unwound, it's affecting many sectors. So it's going to be an interesting one. We're going to keep our eyes on it. And if it's short-lived and we get a rally, that's great. And that is totally predicted on right now. Where it lies is with the employment sector. If the employment can stay reasonably high, unemployment, can stay relatively low, employment can stay high, in other words, full employment or near, we can weather some tough recessions. It may extend the recession, obviously, or stagflation, or whatever you want to call it. But now you're seeing pundits call Kramer. It was like, oh, we need to see 5% unemployment to kind of ease. I mean, people are talking like we need unemployment, that we want unemployment. So that tells me some people see some numbers out there and they think we're going to start getting layoffs. Okay, that's all. We'll see. I mean, I'm not in the prediction business. I'm just in the analysis business. Advanced decline from nothing. It went up a little bit yesterday. More advances than decline. It may try to get up to the 200 like last time. I don't know. The relative strength index 40.5, so it's coming off the bottom, and so a little bit more advances than declines. We'll see. We'll see where that goes. Nothing new there. We talked about sector table. We talked about last segment. We went over where is the market going? Let's take a step back. 4% decline if we use the COVID lows on the S&P. The next retracement level is 4% down. And if we look at off the financial lows, we got another 11% down, and we're gonna potentially get to the bottom of the COVID lows, and that would certainly give us even further declines. So right now, what we're watching if we're going to get to on the S&P or the SPY, the 32.24, and that's the next target. Where we get there, I don't know, but we do probably on the short terms probably see another 4% decline, potentially another 10%, and then Morgan Stanley's chief strategist said 7.4. So we've got some pain that's potentially out there. We want to prepare for it. And we talked about our bear market table. So that's our alert. You want to get out of the last third of DBC. We've had some other of our holdings kick off. I'm going to watch the market for some potential alerts on either energy or add to TVF and TBT. If we get some good rallies the next several days, we want to get into adding some small adds to our short positions. And then with 4th of July coming up, it's going to be less and less trading between now and after a little bit after 4th of July. Holidays, you tend to see a bounce before and shortly after holidays. We'll see how that works out here. That's why I'm saying we may have some chances to add to our short positions. All right, I'm James Twomey. Today's Thursday, the 23rd of June, and have a great day. We'll talk to you soon. If we've got some alerts, you'll get them right away. Bye now.